Well. That tariff announcement was all kinds of bad. Perhaps the only thing that I could kind of highlight is a positive is I think we got a lot more clarity than maybe I expected. I do think there's a lot of open questions. Has a trade war begun? Is this simply nothing more than a chess move that leads to negotiation? I don't know. But I will highlight two things. First, when in the environment or economy changes, when the lay of the land changes, you have to sometimes change your opinion. So, a couple of things I want to get into before we get into the news of the day. I have drastically changed my plan for our portfolio, and I felt like I should talk about this first. So, number one, as you may recall, I thought that interest rates would stay or average above 7% for 2025. That is now clearly a garbage call, clearly wrong. And I am now officially throwing that call away and admitting my mistake. Second, for the longest time, you have heard me say I look forward to 1031 exchanging out of residential properties into busted multifamily deals, basically Class B and Class C deals that were overpaid for by syndicators. I hope to get somewhere between 40 and 50% discount, basically repeating what Olivia and I did in 06. Sell houses at crazy prices, 1031 equity in the multifamily. Struggle for a year or two as you add value and turn the apartments around, and bingo bango, life is good from there. That was the plan. As of yesterday, I have drastically changed my plan. Now what I am looking to do, perhaps in the next 6 months, is in 22 and 23 we did a whole bunch of what was called rate and term refis. We took all of our debt, or I should say 99% of our debt, from, call it 6.5 average to sub 4. We did not extract equity, cash. We left the equity there. We live on the cash flow. However, if we seem to be destined to have a nasty recession, perhaps stagflation, perhaps the Fed cutting multiple times this year, I suspect instead of selling my residential properties, I will simply do what's called a portfolio loan. Let's give some rough numbers. Let's say, for example, we have 4 houses. Let's say the value is $1 million. I don't know. For easy math, let's say we have $300K in debt. So we have $700K in equity. I suspect if things get really bad, we might be able to do a portfolio loan in the 4s, like 499, 495, something like that. At which point, we will probably do a portfolio loan that comes with a 10-year IO period. And to maintain cash flow, we will likely extract, I don't know, again, just making up numbers, somewhere between $250 and $300 grand. And then what we will do with those dollars is we will go shopping. Now, I'm not sure what we will be shopping for, but we will be shopping for distressed assets. That could be distressed real estate. That could be distressed stocks. That could be distressed businesses. I don't know what it will be, but hey, if you are destined to create a recession which lowers rates, I will go back and get liquid, even more liquid than we are now, and I will go shopping. The worst case, I'll put the money in CDs and see what's what. That's kind of the worst case scenario. So again, I thought it was important to let you all know that after this much worse than expected tariff announcement, I have fundamentally changed my plan. We're going to go, ideally extract equity and go shopping versus 1031 exchanges. So with that clarity, let's get into what we learned yesterday. First and foremost, this was pitched as tariff reciprocation. I don't know if you guys have dug into the math behind how they did these calculations. It's not tariff reciprocation. A lot of these countries do not have these significant tariffs on us. This is more about a calculation of trade deficit and the like. So it's kind of fugazi math. It's undoubtedly a formula that's difficult to put together. But the one that was used was certainly has nothing to do with tariffs. So, let's just get that out of the way. It was stated, again, on that big chart, for example, that China has a 67% tariff on U.S. goods. That's just blatantly wrong. But nonetheless, China's got 34% plus 20%. The EU was said to have a 39% tariff on the U.S., and that too is blatantly wrong. But nonetheless, the EU now has a 20% tariff. Vietnam, 46%. Taiwan, 32%. UK, 10%. So again, at least we have clarity, which is something a lot of people have been asking for, but it is going to get a lot more interesting. This is certainly reminiscent. Again, I would tell you, if you were out there and you're studying the economy, I would go back and look at the Smoot-Hawley Act. From memory, I didn't check this morning, but from memory, Smoot-Hawley Act took tariffs up 20%. If the math I read this morning is correct, we just took tariffs up 26%, so worse than the Smoot-Hawley Act. We are forcing businesses to grind to a halt, and a Q1, Q2 recession, not out of the question. A Q2, Q3 recession, not out of the question. It is changing behavior, consumer psychology, and it's going to get worse from here, at least in the short term. This is definitely at least in the short term. Let's talk about what some analysts have had to say. Again, a lot of people with lots of opinions. JP Morgan, the scale of tariff raise is a risk to growth and will cause demand destruction. No question. David Rosenberg, there are no winners in a global trade war. Absolutely. Anthony Raza, these are the most extreme numbers I could have hoped for. David Roche, the tariffs are not transitional. They are core Trump belief, from globalization to isolation. Expect retaliation, not negotiation, aka trade war. Shane Oliver, this takes the average tariff above Smoot-Hawley. Tom Kenny, today's announcements was worse than expected. I think it was worse than all of us expected. Howard Lutnick, rates will be much lower. Well, there is that. There is that. 10-year notes going below 4. Again, I've changed my plan. We're not selling. We're not 1031. We're going to extract equity and go shopping for distressed assets. It is Thursday, so we did get the weekly unemployment claim. It came in at 219, 6K better than the previous week. Again, anything below 250, not a concern. 250 to 300, yellow flag. 300 and above, red flag. We are still not seeing layoffs. We did get Restoration Hardware, RH. Restoration Hardware earnings yesterday were a disaster. And then pile that on with the Trump tariffs, and you got RH down something like 30% in a day. Ouch. Nike's being punished today as they moved production out of China to Vietnam, which we just learned Vietnam has a 46% tariff. It is interesting to note, I read one analyst report that Nike will have somewhere between a $6 and $12 impact on their shoes from the tariffs. But yeah, we'll see what goes on from there. The 10-year note is crashing. Last time I saw it was down to 4.02. Don't know if you guys have checked oil, but oil is down also. It's, again, as we said, Trump wanted lower rates and lower oil. Sometimes be careful what you wish for. It's definitely happening. UBS, simple calculation says that inflation will rise to 5%. 5%, folks. as prices adjust to the import cost. Jerome Powell has got to be perplexed. As I've said for quite a while now in our Sunday conversations with Dan Bird, when we get to June and July, the Fed's going to have to make a choice. I suspect by July, inflation is going to be up. It might be up significantly. And if, the soft data on the economy is true and we are in a recession, what's the Fed going to do? Is the Fed going to cut to fight growth? Is the Fed going to raise to fight inflation? Or is the Fed going to do nothing? No, not a lot of good choices. GDP now has been updated. It now has a negative 3.7% growth for Q1. They did do the gold adjustment. It now is negative 1.4. It was 0.5% a few days ago. It's very interesting to see that nowcasting has GDP shrinking in Q1, where the experts have us all positive, 0.3 to 1.5%. So yeah, it is getting interesting out there. The last thing I want to talk about is the one and only Joseph Wang. Joseph Wang, the Fed guy, great follow on X or Twitter, somebody that I've had on the channel a couple of times. He sent out an excellent tweet, I guess they're still called tweet, yesterday, saying basically tariffs are dovish. Big tariffs are very dovish. To which he had a lot of haters reply. I replied with basically, Joseph, is this what you mean? Tariffs equal demand destruction. Demand destruction equals recession. Recession equals rate cuts. Perhaps even emergency rate cuts. And Joseph Wang gave my comment a heart, which I'm going to take as a fact that he agrees with that. So, folks, at the end of the day, the announcement yesterday was much worse than expected. I think it's fair to say that the formula behind the calculation was interesting. Fugazi is something that comes to mind. We did get a lot more clarity. Now we wait. Do countries negotiate? Does a full-scale trade war happen? Does the American consumer, the American business shut down? Sit on their wallets? But at the end of the day, we are investors. I have certainly did not want what happened yesterday, but I react to what happened, and I have changed my plan. At the end of the day, what we're going to do when the environment changes is we're going to change our strategy. We're not going to 1031. We're just going to extract equity and go shopping. All right, everybody, take care of yourself. Sorry for that little blip at the end. Later.